Yo, yo, yo.
Yo, man, how we doing?
What's up, River? Is this River?
Yeah, dude, how you doing?
What's up, brother? I'm good. How are you?
Good, dude, just hanging.
That's what's up, man.
Yeah,
Do you trade futures?
yeah. I mean, some. I'll talk a little bit about it tonight. Not
Right.
often, but yes. Uh-huh.
All
When
right.
when the time presents itself, I will. But nah, I don't love them. They're, I mean, they're fine. They're fine. If it's what you like to trade, you can trade it. A lot simpler than options, that's for sure.
Yeah,
So some people like that aspect of it, you know. You can have a substantially more defined risk, substantially more defined reward. So there's definitely some good and some bad that goes along with it.
for sure, man. I just got funded and I was up and I made one bad move and I went down, hit my stop loss, and then I was okay.
Yeah,
I'm gonna amplify what I have learned, and I made it back last night.
yeah. And I mean, that's like, that's the thing about it. We're going to talk about it tonight is just the risk is wild. And if you aren't really paying attention, like, like, I mean, especially on something like, NQ or something like that, people don't realize that a candle like this on NQ can wreck you. You can lose your whole port
Yep,
with one candle, and
very
so,
true.
and so people don't, you know, they might just look at the chart and be like, oh, that's not very much movement. But then when you realize that it's NQ and that's 25 points and that's gonna wreck you, then you start to slow down on them a little.
Yeah,
But we'll see how many people even show up tonight. That was, we've had a couple short weeks, random weeks like that lately, and so oftentimes these classes are empty. So that's why I figured I'd go for something that might not interest too many people, but maybe the people that are interested will want to join in.
for sure, man. 1K, what's up, 1K?
1K, how we doing?
Doing good. How you guys doing, man?
Doing good, doing good. You just coming home from the bar?
No, no, no.
Uh, just
It makes
just
everybody think I'm an alky, man. Keep saying that
just
because I
just
uh,
going to the bar. Nice.
going
just
to the bar.
passed it. They see me
Dude,
pull up and said, "No more, no more."
no more drinking. River, I was outside. I live in Brooklyn, so there's this like place called Sheepshead Bay, and I was outside, and there was a thunderstorm. Yo, bro, dude, the rain just started pouring, bro. I'm just walking in the rain, just soaking wet.
Dude, yeah, I saw that New York got pounded by a quick little thunderstorm there.
Yeah, man, shit was crazy, bro. I enjoyed it though. I was walking slowly, just enjoying the getting wet.
I've only been to New York once, and I didn't go to the city. We were on Long Island for a week. It's like really
Oh,
good.
oh, Long Island.
Yeah, it was
You have
great.
family there?
No, my lady's like mom, her whole side of the family's from New York. Some of them still live there.
Oh,
So we just went out to see them. Bunch of cool people though. Really, I love it. I loved it, and I love those people, and so we had a damn good time.
that's what's up, man.
Yep.
Yeah, man. New York is Long Island is nice, man. I have family in Long
Yeah,
Island.
it was good. Yeah, it was great. It was great. But I didn't like I can't really like I feel like I can't really say I've been to New York. Like I have, but like I haven't
Yeah,
really.
basically, yeah. I mean, yo, if you come to Brooklyn, let me know, man.
Yep,
I'll show you around, no problem.
that'd be sick, dude.
Small little
South,
gap down, huh, River?
especially South Brooklyn. South Brooklyn is lit, man. A bunch of cafes, restaurants.
I bet it's a good time. I've been listening to music out of that place for a while, so need to get out there. Yeah, look at that, dude. Norvin was mega bear before that future closed, and now shit, we're up 230 points on NQ since he said dump the market 1% up from the close.
Hey, did the futures open up again, River?
Yeah, yeah.
Let me go check it out. Damn.
Ripper.
Woo! ES was just at five. Whoa.
Ripper. They,
Crazy,
they
bro.
didn't want it under that 6,000 for too long, I don't reckon.
Dude, I think with futures, it's just like liquidity sweeps. Like you just gotta find a liquidity pool. That's why I realized like just liquidity.
Yeah, well, and I mean, just the interesting thing about him is nobody trades him, which we're also going to kind of talk about that tonight. nobody trades them. You know, they're a very, very low liquidity market. And they can get to moving. You can get this kind of stuff that like maybe you wouldn't get on SPY, you know. But when you got, you know, 4,000 total contracts and this thing's ripping, you know, 30 points, 20 points,
Yeah,
whatever that is, you know, it's crazy.
you're cooked. I mean, definitely like what's like I have a stop loss. I started using a stop loss on it and it has helped. Like stop
Yeah.
losses will help you because you can always re-enter into a trade.
Yep. Yep. That
So,
instant settlement makes it nice. But it is one of those things, you know, like when, and we'll get more into this in a second, but it's why I tell people to avoid NQ because you might
yeah.
be in a valid trade, but the moves are so like, you know, if
Weird.
like, and if you're trading, you know, if you're trading and you just have like maybe you're trying to buy this dip for a bounce back up to there, buy this double bottom or something, and you got your stop below those lows, well, this thing pushes 10 points past it. So, you know, all of a sudden you got 200 extra loss if you're on a mini, you know, and like you'll get stopped out, you know.
Yeah, 100%.
Yeah. So it is a little tricky.
And
Oh,
I
well,
think with futures, scalping is way easier because I was scalping last night and I was like,
yeah.
oh, bro, like it's actually way easier than options. You could say,
Yes.
you could
And
say
it's
that.
well, and it's so defined. You know what you're getting. That's
Yeah.
the really nice part, you know,
Yep.
like if you're buying at this EMA and you're looking for a bounce to this EMA,
Hmm.
you get a look at it and say, boom, 10 points. 10
Yep.
points pays me this much, you know, and so
Exactly.
it does, it's very defined, which is
More-
why some
Yeah.
people like it a little bit more, you know.
Yeah.
Options are they're the most advanced financial market or financial instrument in the market. The amount of
Sure.
outside influence going on with those things, you know, as we've seen, a lot of people get wrecked trying to trade them.
Yeah.
Futures are, you know, they're whilst they can be substantially more dangerous, they are a lot more simple.
Yeah.
Okay, let me make one more post and we'll get to rolling here.
What have helped me too, like I think you mentioned before is when the options go like into volatility, like it shoots up to sell.
Yep.
I used to not sell and I used to lose money. So now anytime I see a pump, I don't care if I missed out on profit. I always sell.
Yep.
It has
Yep.
helped me a lot. I appreciate that.
Yeah. Oh God, it helps a lot on options. Always sell into that little strength, you know. Yeah, it's good. It's good. But on futures, it don't even matter. Target is
Yeah.
target. Stop is stop, you know.
It don't
Um,
matter.
post. Okay, give me 1 second.
Did you swing any options for puts for on Thursday for Friday?
No way. I would not. No, no. That setup to me was not a swing short setup at all. I mean, I started looking at this and like, I mean, if anything, I would have been swinging long off of this, no questions asked. You're gonna have that nice support down there, you know, 595, like we talked in our class last week. Maybe it was 2 weeks ago. Buy any of those dips into 595, buy any break of 595. We were rewarded real big time on it last week at some point. Maybe that was even Friday. And then you know, I'm long and strong, but if I'm around 595, I'm long, no questions, you know. And then now we'll see. We'll see what we end up doing. SPY should
Yeah.
be SPY. Is it open yet? It says it's trading.
Let's see right now. Let me go on.
But currently SPY is sitting on a gap down. So
That's what I was saying. I wasn't joking about Northern. I was legit curious on Spy. I'm
Yeah,
confused.
it is a
yeah,
yeah, it is on a gap down right
oh
now.
well,
Yeah.
this is
Is it because the holiday?
it's probably some weird like holiday settlement thing going on, but it's also probably because of the waiting and like Apple and them. I gotta believe, and who else is in that league? I gotta believe all those like Apple meta names, all of that are likely gonna get wrecked. So SPY could see some weirdness once now that everything's open, you know. I mean, we even saw it right here. Don't know what went on there on meta, but okay, welcome everybody. Happy to have you here, Dirty River. Definitely different lecture tonight than I normally do. You guys know I love to really focus on technicals, fundamentals, all of that stuff, big pictures in the market. Tonight we're doing a bit more focused. We're going to be talking futures trading. I was talking a little bit, some people might have heard me. I trade them. They're all right. It's just not something I love. I love trading options, so that's what I trade. But like I always teach people, find something you enjoy trading and trade it. That's the best thing you can do. If you're liking what you're trading, the example that I always use is myself. I trade AT&T. Why? Because I like to. There's a million cheap names out there. There's a million different things that you can do. But I like trading AT&T, so I trade AT&T. Should everybody trade AT&T? Absolutely not. Find something that you like. And we're going to get into these at the end of it. There's these things now, prop firms. Well, I shouldn't say now. A lot of people don't even realize, but they've actually been around for 20 years or something like that. They aren't this like brand new thing in the market. But retail traders have found them, and retail traders are, well, I'm going to say attempting to use them very, very heavily these days. You see it all the time. We see it. We see it in GameStop here. People posting profits and losses from them. We of course know if you're on a prop firm or not. And so we're going to get into those a little bit later. But today we're going to start with just talking futures and what are they and how do they differ. And when people are talking about them, some of the terminology, just some of the things that you need to know. I will say, I am personally not encouraging anybody to go trade futures. Are they fun? Sometimes. Is there a time and a place for them? Absolutely. But don't, I want to make this very clear. Hopefully I'll remember to say it a few more times through this lecture. I am not in any way, shape, or form encouraging people to go trade futures. I just wanted to talk about them, teach what they are. We aren't going to be talking how to trade futures today, because it doesn't matter what you are trading. Your trading strategy should be your trading strategy. It doesn't matter if you're trading, AT&T contracts, SPY contracts, or futures. It doesn't matter. Your strategy is your strategy. So tonight is not a discussion of, how to trade futures or anything like that. We'll of course be talking about some things on the charts in relation to them. But it's more about what are futures and how do they work, and why do people use them and who uses them. So with that, I'm just going to pull up a chart. First one I'm going to pull up is ES. If you ever hear anybody mentioning ES, well, there's a stock ES, Eversource. Some people pull that up by accident, but on Thinkorswim, it's going to be /ES. And what is ES? It is the futures for the S&P. We have SPX, which is the non-weighted market cap based S&P 500 index. We have SPY, which is a weighted smaller, not necessarily smaller, but 1/10 the size of SPX, and it's affected by, it has weighting. So SPY holds Apple, or a bunch of Apple, a bunch of Microsoft, a bunch of Nvidia. So when those move, they tend to move SPY. You guys know I watch those all the time. That's how I trade. ES is closer to SPX in that its values are based on market cap. They aren't based, there's no weighting to it. It's just all calculated based on market cap. Another one of them, NQ. Obviously, as you can imagine, it's QQQ. It's the tech sector. Much bigger number. You see it trades at $21,900. We're going to get into that in a little bit. They are just another way to trade the things that we like to trade. Maybe you like to trade the Dow. Well, there's YM. That's going to be your Dow futures. So they have markets for all of the big indexes. They also have oil. Most of us, or, most people that trade, if they're going to take an oil trade, it's likely going to be an XLE trade. Maybe it's going to be on one of those individual names, your Exxons, your Shells, whatever it might be. But there's also oil futures. So we see these numbers over here. Again, 74. We're going to kind of get into what these numbers mean now. So we'll talk about oil just because I have it pulled up. This price that you see over here, 74, this is telling you the value of a barrel of oil right now. So light sweet crude, that's the type of crude oil feature that this is. This is telling you that a barrel, 42 gallons of light sweet crude is trading at $74 right now. That's what the value is. Obviously, if we zoom out, we can see some, some times where, 2022, obviously gas got very, very expensive. 2020, gas bottomed out. I mean, some of the markets went negative. It's more of a theoretical negative than an actual negative. And then obviously markets rally. We can see, and the charts, the charts are always what tell us the most, the most important thing. When you look at this chart, we notice that basically since, the early 2000s, Middle East stuff starting to happen, very profitable point for oil, for the oil makers, is going to be between 60 and 90. Oil makers and sellers, as weird as it sounds, they don't love these blowouts because blowouts lead to drops, and drops hurt. There's, when you read about the oil people, it can be heartbreaking when you have, it's boom and bust for those people. The booms are okay while they're happening. The bust that comes after destroys families, destroys oil companies, destroys everything. So we know that oil likes to trade in this range, and that is what this is representing to us. The price of a barrel of oil. You guys can see I trade oil on occasion, or I at least like to pay attention to what it's doing. Unfortunately, now with the new administration, we aren't seeing the direct correlation of oil prices to pump prices anymore. I haven't quite figured that out, but how do we trade this? And I'm not talking technical analysis or anything like that. And we're going to keep talking oil, unless you guys want to talk something else. Oh, Rob's, how we doing? Yep, Big Joe, find something you love to trade and trade that thing. And yep, very good advice. Paper trading before anything futures is always good. We're going to get into that too. And I love that, Crashes.
Yo, River, I have a question over oil since you're going.
No, Norvin, we ain't doing this. Was that Norvin? We ain't doing this tonight, Norvin. You can, because futures are dangerous, and the last thing we need is kind of your I know you're the oil man and you deliver oil, but we can't have like the Norvin
No, nothing like that, River. Just
the Norvin
chimings.
You
said that like buyers like to keep it around $90 to $60
yes,
where they become more profitable. So considering refineries getting blown up in the Middle East, and obviously what's going on,
yeah, but you got to remember, who cares if one gets blown up? They'll have a new one built tomorrow. Like that doesn't matter. It does. Those Middle Eastern dudes, they'll pump out oil. No issues. No issues.
So you're saying that like oil could spike to like around 82, 85 and then have a nice pullback?
I mean, trade. Well, I mean, trade.
Trade the
I'm
range. Sure you know more since you're more experienced. When usually oil pumps, VIX usually goes with it.
So here's the deal, oil. So real quick, and then Norvin will give you 5 minutes at the end for your questions. So the oil market. This is a side tangent. This isn't about futures. This is a side tangent. Many of you have heard me say, and I will stand firmly behind it. The market is not manipulated. The stock market, as people think of it, and as they think of manipulation, is not manipulated. There is a couple markets that are in fact manipulated. Oil is one of them. Big money controls this. Things go on behind the scenes every single day that we will never know. We will never understand. They can suppress it as much as they want. They can pump it as much as they want. This is a market that is absolutely manipulated to trade oil, and to trade oil very well. And I'm discussing, Exxon's, your Shells, all of that, trade them technical, no big deal. Of course, oil news is going to affect them, but you can trade technicals on that. The good oil traders in the world, the amazing oil traders, and these aren't, we'll never meet them. These are the guys that have hundreds of millions of dollars and are trading in oil. They are trading fundamentals and sentiment around oil and news and all of that. It is always going to outperform the technicals on oil. We can all look at this and say oil should have bounced off of this 65 level. Well, news got us under there, so oil's scary to trade. In fact, Norvin, I'm happy that you brought this up because we're going to get away from oil. We're going back to ES. So ES, this is the S&P futures. This is likely what most people, if they were going to trade futures, this would be where they started trading futures. As you can see, trades at 6,000, you know, I mean, if you pull up SPX, well, I guess it's not moving right now, but similar numbers to SPX, all of that. Well, what do these numbers represent for us as futures traders or potential futures traders? Well, it makes our lives easier. So, you know, a lot of us in here, we trade options, you know, hopefully you don't trade SPX options, but maybe you trade SPY options or QQQ. And we all know, you know, a nice pop pays you really good, pulls back and gets back to that same level. Your contract's not worth the same. On futures, every single thing is extremely defined. So when people discuss futures, you're going to hear, we're going to get a little more into terminology here. You're going to hear two things discussed: points and ticks. And what is a point? A point is $1. There are some exceptions to this rule. I'll touch on one of them in a second, but a point is $1. If you go from 60.19 to 60.20, you made 1 point. A tick is 1/4 of that. And so, you know, 60.19.25 to 60.19.50, you made 1 tick. And so how do we use those? Well, that is how you are paid in futures. And we're going to talk contracts here in just a second. But when you trade ES, there is, or gold or NQ, it doesn't matter. They're referred to as futures contracts. However, they are absolutely nothing like an option contract. That's not what futures contracts are. A futures contract is one of two things. Well, technically speaking, there used to be a third one. It's called a full contract, but you might have heard people, we don't have those anymore, thankfully. They're insane. You might have heard a mini. Somebody talks about, I'm trading minis. And as weird as it is now, mini is actually the bigger contract. The smaller contract is a micro. And so what do they represent? Basically shares. People try to make futures extremely confusing. They aren't. If you are trading a mini contract, you will enter it at a price. Let's just, you know, we're just going to pretend. If we enter right here 60.20, or we'll just say we entered at 60.20, just random number. If we are in a mini contract, it is the equivalent of 50 shares. That's all it represents. You know, and so what does that mean? That means if you make 1 point, as we discussed, that's $1, you will make $50. If you go down $1, you will lose $50. That's why we use points. That's why we use ticks. A tick will pay you 1/4 of it, obviously. So if you're in a mini contract and you buy at 60.20 and you sell at 60.20.50, you're going to make $25 because that is 2 ticks. A tick is worth $12.50. You get 2 of them, you make $25. A point is 50. So for every $1 you move, you're making 50 or you're losing 50. So just think of them as shares. Don't get me wrong, you know, there's fees and stuff included, few bucks, doesn't really matter. Well, that's a mini. As you can imagine, that's very high risk. You know, we look at, you know, well, maybe this isn't going to be the best candle, but we look at this candle right here. It was 6 points up. If you're trading a mini contract, this is paying you or losing you $300. So that is where the risk is involved. You know, because this is virtually 10 times SPY, you have to think of it like for every 10 cents that SPY moves, you're making or losing $50. So when you think about how easily SPY can move 10, 20, 30, 40 cents, you can have hundreds of dollars of risk on the trade. So we're just going to use a super generic example right now. I'm going to edit this just to make our math a little bit easier.
So River, like for the ES right here?
Nope. So right here, let's pretend that we buy at 60.20. And let's say we're targeting these highs. I'm not going to say that that's going to happen, but we can look at this trade and we can say, our target, we'll call it 60.29. We are looking for 9 points up. We can make $450. Our stop, 615. I just want to emphasize this is not a trade to like take right now or anything like that. Our stop right here, 615. We know 5 points, $50 a point, $250 risk. Very, very defined. That is what makes futures, I don't want to say easier, but a much easier to understand because your risk is so defined. If we say we buy an option right here and I tell you our stop is down here, I can look at the Greeks, I can do all of that, and I can say, you know, we're going to be risking 10 or 15 bucks per contract. What, you know, I'm just making up random numbers, obviously, but we're going to be risking 10 or 15 bucks a contract. Well, in futures, you are risking $250. No ifs, ands, or buts. That is what it is. So that's a mini. Well, a micro. This is what I recommend to every single person who even considers trading futures. You know, anybody who considers trading futures, trade micros. And so what is the difference between a mini and a micro? It is 1/10 the size. So where a mini represents on ES 50, you know, you get $50 per point, a micro pays you $5 per point. And so if you're trading micros, and I know it's smaller numbers, blah, 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 that's smart. You know, you're trading futures, it's high risk. If you're trading micros on this, you're only risking 25 bucks and you're looking to make 50 bucks. It's a nice one risk to reward trade. You know, whatever it is, you know, same or, you know, whatever, 45 bucks. Same math, same everything, just a safer contract. And so when people discuss trading micros, that's oftentimes what they're going to be trading. So does everybody get points? Oh, I see a question here. What's a pip? So pips are in the futures market, but they're used in Forex. And so it's, you know, I can't think of a Forex thing off the top of my head. A pip is not the same as a tick. So don't listen to Norman. A pip is not the same as a tick because Forex is often, you know, Forex is wild because you use, and we're going to get into this a little bit, even with these futures, an appalling amount of margin because you have to think when you're trading Forex and people are making, you know, they're getting a couple few cent move on the dollar or whatever it is, and they're making thousands. That is because the margin and the leverage that they are using is massive. So a pip is it all depends on the currency, where it will be in the decimal place, but it's oftentimes going to be 1,000th of, you know, a dollar or whatever, or, you know, 1,000th of a dollar. So it's just another way that the Forex people talk about their trading. We are not getting into Forex tonight. Forex is a little bit, it's crazy. It's a risky market. So we aren't talking Forex tonight, but a pip is just used in the Forex market. You might hear people try to use pips in futures, but anybody who really trades futures will quickly correct them and tell them it's a tick. So everybody gets points. Everybody gets ticks there. Okay, great. So now we're going to talk about a couple of the other markets and talk about the points associated with them. So like we said, you know, on ES right here, you got your 6-point candle. That's a $300 candle. If you understand your risk and you understand all of that, I'm not saying it's good or bad risk, but you understand that it's big risk. Well, this thing trades at 6,000. So we understand, you know, that's 1/10 of SPY, or, you know, that's 10 times SPY. So every 10 cents on SPY, give or take, is going to pay us some money. Well, another one of the common futures, the one we touched on earlier, is NQ. And as I mentioned earlier, NQ trading at 21,000. So, you know, it is substantially higher risk than ES is, because this is give or take 40 times QQQ. So when you look at something like this, you know, this is that same, you know, this is that same candle that was on SPY. There's some slightly different math here. So SPY, you get 20 bucks a point, or 50 bucks a point, or if you're on a micro, you get $5 a point. On NQ, you get $20 a point instead of 50, or $2 a point on a micro, which sounds weird because you're like, well, hey, that's less money. Well, then you take into consideration what these candles are. So if you're trading a mini on NQ, quick math in my head, every 2.5 or 3 cents that QQQ moves, you are going to make or lose $20. So you have to be prepared for that volatility. Then on SPY, you know, we looked at this. This was a nice 10 point move or whatever. Well, on NQ, this same move was 60 points. That means if you held your contract from here to here, which is, you know, $1.50 or whatever on QQQ, you have $1,200 of risk on this trade. You know, if this pulls back this far, you have $1,200 of risk. So there's massive, you know, there's massive amounts of money to be made and lost. You know, you look at this candle on NQ, obviously you couldn't really swing it. This is a 100-point candle. This is a $2,000 candle on one contract. And so you need to be very, very, very cautious if you go to trade something like NQ. Another one that, and so, you know, I'm just going through some of the points and ticks on some of these. Another one that a lot of people trade, you know, the GLD trade, the gold trade has been wonderful. These are the gold futures. So, oh, okay, hold on, I have to backpedal real quick. So, final thing about these contracts. You know, I said, you know, they aren't an option contract. You know, obviously they're very different. Well, where they're similar, they have an expiration date. So when you trade the futures contract, you can see right here, the current contract expires in September. And so or at least it's pulling up September. Maybe it expires. Maybe the recent one expires tomorrow for OPEX. But this contract expires in September. So you can theoretically hold this thing all the way to September. No fees, no theta, no none of that. You know, your entry is always your entry. Your stop out's always your stop out. Your exit's always your exit. The prices will always be the same. So they are not affected by time. Well, these do expire. A common thing that people are just getting into futures, you'll hear them say things like, oh, we'll never hold a futures contract to expiration. That, while that's kind of true, it also doesn't necessarily matter. You'll run into liquidity issues later on, you know, as the contract's getting closer to expire, people will start trading the next month. We're going to get into that in a little bit. But when they expire in something like NQ or ES, if you're in profit, it doesn't matter. You know, if you're in there at 21,900 and it closes at, or 21,900 and it closes at 21,915, you are going to be closed out for 15 points profit because that's where the contract expired. If you're in the red, you're going to be closed out for that loss. Well, where holding to expiration starts to matter is something like gold. So, you know, a lot of people have been trading gold, and again, what does this number represent on the side over here? This is what an ounce of gold is worth, $3,380. That's what an ounce of gold is worth right now. And so that's what this is tracking. However, this one trades a little bit different. So we buy a gold contract. And again, we're just using completely, you know, completely arbitrary numbers. We buy a gold contract. We're long at 3,382. Well, on this one, a tick is 10 cents. So, you know, what I'm trying to demonstrate here is that each one's a little different. If you're going to trade one, try to learn it. So a tick is 10 cents, and a tick on a gold future pays us $10. So for every $1 gold moves, you make or lose $100. And each tick, every 10 cents on it is going to pay you $10. Well, these contracts, unlike your Dows or NQs or ESs, these contracts represent something, and they represent something scary. So these, off the top of my head, I believe that gold contracts represent 100 ounces of gold. So say we buy our gold at 3,000, you know, we're in our gold contract at 3,382. Well, if it expires, and we're in profit, well, this contract becomes what is known as deliverable. So say we're in profit or we're in a loss, you know, it doesn't matter. You are making an agreement to buy 100 ounces of gold at $3,382. So if you hold this contract to expiration, then you now owe your broker, who will deliver you 100 ounces of gold. You now owe your broker $338,000. So that is where the risk of holding these to expiration comes. Same thing, we're just going to touch on it on oil, just so people understand the risk. Oil also represents something. Off the top of my head, I believe it's 1,000 barrels of oil. So if we're in oil and it exercises and we're in there at $74, we now owe $74,000. We also have 1,000 barrels of oil about to be delivered to our house or wherever it is, you know? So that is where the risk in holding to expiration is. On your NQs and your ESs, it doesn't matter. They're just going to settle you out for the loss or the gain, whatever it might be. Well, now we're going to get into a little bit more of the contracts. So when you trade futures, depending on brokerage, you need a large amount of margin. And this isn't margin like, it's a different margin than stocks, where you're basically borrowing money and you're paying a fee to borrow that money. If you buy a futures contract and you end up not having enough cash to cover whatever their margin requirement is, they will close you out of the trade so that they never lose their own money. You know, you can't lose. There are times and places where you can lose more than you have, but on a reputable broker, they're going to close you out long before margin call time comes. But why is that margin there? It is to offset a portion of the cost of that contract. And what that cost is and what that thing is what's known as notional value. So like we discussed, you know, on those, the notional value of a futures contract is 74 or whatever, you know, wherever you get in there, the notional value, the real life value of it is $74,000. Well, margin wise, you don't need the full $74,000. But depending on your brokerage, the margins can be very high. On Thinkorswim, for example, if I want to enter a trade on you know, when I want to enter a trade on futures and I want to get long on oil, I need to have $14,157 of available margin to even enter one contract on that trade. On something like ES, it's even higher. If you want to purchase one contract of ES, you need $25,500 to back you up. I will say, if you go, you know, if you go to Tradeovate or anything like that, you can get substantially lower margin rates, you know, $400 or $500 or whatever it is. But as I said, you will always need margin to back it up. And so I'm just gonna give an example where this can go against you. And so we're going to go back to ES just for sake of people understand it. And we're going to talk about Tradeovate because that's a brokerage that if I trade futures, that's what I'm trading on almost always. So they have on minis for a mini contract, they have $500 margin. You need to have $500 in your account to open that trade. Well, if you have $550 and we long 60.21 and it drops to 60.20 and 90 cents or 75 cents, you know, so we go 1 point down, just over 1 point down, my brokerage is going to close that trade because I no longer have the margin to back it up. And so there is that risk in futures that, you know, and micros are cheaper, $50 margin. So if you got, you know, $100 in there, you have a little bit of playroom. But if you're going to trade futures and you're going to trade a personal account, you need, you know, I don't want to say I don't want to say you need a lot of money, but to safely trade futures, you likely need a pretty substantial sized account to make it safe, to make it, all of those things. Well, again, I'm not recommending anybody, trades futures or anything like that. And so we're going to talk about who does trade futures. We've talked about what they are. We've talked about how points work. We've talked about how ticks work, covered a few of the different things. And so now we're going to talk about who trades futures and what are they used for, and, what's big money doing with them, things like that. And very few people trade futures is how I'm going to put it. It's a very illiquid market. Obviously, you can get your fills where you need to get your fills. You oftentimes aren't going to get busted by a spread or anything like that. You can have what's known as slippage, where you set an order and it might fill you a tick or two different. That's just due to the lack of liquidity in the market. So who's trading these? Well, algos. Obviously, we know algos are always trading a little bit. You see these ones pouring in nonstop at the same price, things like that. Oftentimes going to be algo trading. That's going to be most of your volume on the day. Well, another big use of them for big money people is hedging or protecting against unexpected news or volatility at night. We've had some of those days where the volume just goes crazy in the after hours. You have some big old uptick, war news, tariff news, whatever it might be. If we go back and look at April, some of those moves down, big money was absolutely involved in trading those moves down and hedging using those trades. But as a whole, not a lot of people trade in the futures market. Some of the other people who do are obviously very, very wealthy people trading in those oil sectors, or trading oil, trading gold, trading the Dow, whatever it might be. There are some hedge fund desk traders that are trading futures. They're going to make up a pretty good chunk of it that are they're going to be in there. They're going to have their set profit goal for a day, very defined risk. And their job is to basically show up and get, 50 points or whatever it might be. And that's the futures market. It's just not traded in heavily. Not too many people focus on it. I often like to use it a little bit more than I like to use SPX. I'm not going to say 6,000 matters more on ES than it matters on SPX, but I watch futures and I trade futures. So I like to use their big picture numbers, your 6,000s, those kinds of things for myself personally.
Hey, River.
I'm not saying quit, looking at your SPX for big numbers or anything like that. But I like to look at ES. What's up, 1K? What you got?
Kind of just on this topic right here, but sometimes I'll message you like, "Hey, how's your morning?" You'll be like, "Hey, I'm just trading futures." Like, what? I guess it may not be the reason for everybody. What's your reason why you would just at that moment be trading them?
Got a wild hair. Like, if I'm being honest, like no real reason. When a good time to trade them is nighttime. That's when I will often use them. Like obviously one of the big nights that I traded was election day, wherever that was, probably back here. You had to be on futures. I mean, it was massive risk, but the risk was worth it to be in the market during those big moves. And so that is one of the great advantages to futures is you can trade it 23 hours a day. And oftentimes, even on these closed days, they'll be trading like, futures traded today. They did their normal close, for a few hours. But then generally speaking, when market is trading, they will open Sunday afternoon at 3 or 6 o'clock Eastern time. And they will run until they close the following day at 5 o'clock Eastern time. And then they reopen at 6 and they go for another 23 hours. So for me, the times that I trade them are when unexpected volatility is showing up in the nighttime. And I'm like, okay, I'm jumping on right now to, get involved in this. But That's the main time when I'm personally going to use them. But I'm not saying it's right or, you know, wrong or anything, because this intraday volatility, like these types of wicks, you know, as we like, you know, as we discussed, we'll just go to NQ. When you're trading intraday, and this type of stuff happens, like say goodbye to your port, you know, if you know, maybe you're trying to long this bounce off of the VWAP or something like that, suddenly the market's gone 86 points against you and you're very likely stopped out. You're down $1,700 on this one wiki candle. I don't like to get involved with that. I actually saw somebody, they just said, I won't say it's more directional at night. Personally, I think if anything, it is substantially more choppy at night. Obviously, right at the opens are volatile, right before New York Open is volatile, but oftentimes you get very, you know, we've had crazy news lately, but you'll get these nice tight ranges. Like you can almost tell when nighttime is because we sideways, you know, they'll give you some nice, like nice safe movement in those after hours. So that's something that I like. I'm not going to say it's right or wrong, but that's how I like trading them at night. And even just scalping this kind of stuff at night, you slap some B bands on there and trade some B bands, and you're kind of off to the races. You know, it's something that's what I like to tell people. You just kind of short these bands, buy these dips. It works really good. Let's see. I just saw we got a couple questions. Rudy. Yep, I trade everything the exact same. Doesn't matter what it is. Obviously, it's harder at night to be tracking what Apple and Amazon and all those are doing. But thankfully, you know, Thinkorswim, they got 24 hours on most tradable things these days. So we can track them pretty good. You can, of course, wind up with some weird volatility that you don't expect at night, but it's oftentimes going to be news.
Hood
Yep, exactly.
150?
Oh my God, Norman's back. Yep. And so that's futures, you know, like I said, super simple. Think of them like glorified shares. You know, if you're trading ES and you're trading micros, you got 5 shares of ES. If you're trading minis, you got 50 shares. If you're trading gold, you got 100 shares of gold, you know, or 100 ounces, depending on how you want to look at it, you know? And so just think of them that way. They're very simple. You know, they trade just like shares. They have very defined risk. You always know your entry is always your break even. Your stop out, if your planned stop out is $250, it is always going to be $250. No theta, none of that. You need a bunch of margin, you know, obviously, depending on the brokerage that you're using, you need a bunch of margin, and you need to have a very defined strategy. People who are just winging it, hammering micros until they're break even and then trying to catch the bounce to just get out safely, they never ever last. We all know that trading is one of the most prime examples of beginner's luck that you will ever find. The amount of people that I've met that trade for 2 weeks, make 30 grand, and a month later it's all gone because it was just luck is basically everybody. You know, it is the same thing with futures. People show up and they try to scalp their, you know, oh, I'm just scalping 5 points or whatever, you know, $100 every time I scalp it. Then they get caught in the one candle that flushes 30 points against them and they give it all back. Or they keep holding and they keep adding and it goes against them and they give it all back. And so very defined, you know, define your entry, stops, exits, all of that, follow very strict rules. And futures can be a simpler and potentially, I don't want to say safer, but due to how much more defined your risk and reward and all of that is, they are a little bit safer. They're definitely a little bit easier, but they just carry a lot of risk due to the amount of money that can be, you know, everybody always talks about you can make so much trading futures. They leave out the part that you can lose it all in one wrong candle, you know. Think of anybody, you know, I mean, I'll just use Norvin as the example. Dude was screaming short the entire market, you know, we are going to die. Market closes and now we are up 243 points. So on NQ. So if you were in NQ and you swung short, you're down $4,800 right now. You know, and that is, you know, and that is in the matter of an hour. So
Yeah, but that was news related, but technically it's still a downtrend, right?
No, it's chop. Where is a downtrend? This market is going up and to the right. bottom, which way is it going? It's going this way. There ain't a downtrend anywhere.
Burger King.
You can make an argument. You can make an argument that we're in a nice range right here, but there ain't no downtrend. There's no downtrend. You know, there is no downtrend. The market is straight up. You know, and sure, maybe this was news, but I mean, yeah, it was someone getting killed. You know, you don't necessarily expect it to fly. You know, but so with that, we're gonna get into the final part of this lecture. It's gonna be short. Some of you are not gonna like what I say. Some of what I say might be taken personal. None of this is a personal attack on anybody, but it's something that we really need to be aware of. And it's prop firms. Are they good or are they bad is up for a bunch of debate. For anybody who doesn't know what they are, a prop firm is basically a company where you can pay a certain amount of money. It's different for amongst all of them. And then they give you basically a test to prove that you know how to trade or whatever it is. And if you pass that trade, they give you, or if you pass that test, they give you what's known as a funded account, and you're actually able to start trading. There's still paper trade accounts until you've really proven yourself, but the company will, as long as you follow their rules and do what's required of you, they will actually pay you out some of that money you can make. Well, they're a very double-edged sword. Many people move to prop firms because they were unsuccessful at options. And, you know, they might give you, you know, you can go to this prop firm and you can pay them $50. And one of the shady things, or I consider it shady things that prop firms do, is they give you this very false sense of what you're actually receiving. So I pay 50, and I'm going to use random numbers. For anybody who doesn't know what prop firms are, you might, you know, you might be a little confused, but say you own a prop firm and I come to you and I give you $50. Well, now I take the test. Oftentimes, you know, if I give you $50, they're going to say you get a 50K account. And so people think, you know, oh, I got $50,000 to trade with. You do not. You have $2,000 or $3,000 to trade with. So they give somebody, you know, you pay them your $50, and then what your job is, and it depends on the brokerage, if it's in 1 day, 2 days, 3 days, whatever, what your task is to make a certain amount of profit. And they're going to tell you, you get a $50,000 account, you have to make $3,000. If you make $3,000, then you get to move into the account where you can actually make money. Well, if you lose $2,000, you lose the account and you have to give them another $50 to start it over. So they label it 50K account. There is nothing 50K about it. If you have $2,000 you can lose, it is a $2,000 account. Well, where this becomes an issue is they tell you you have a 50K account. Then they tell you, oh, and you can trade 5 minis. So that's what people do. I personally don't think that prop firms are super predatory. I think people are stupid and they make the wrong decision. Just because you have the ability to trade, you know, 5 minis does not mean that you should. And if you can only lose $2,000 and, you know, you're in 5 minis, then, you know, we'll go to ES for the example. You know, you're in 5 minis, you can only lose $2,000. That means that you have 8 points that you can risk. So you get a move from this high to right here. This move, your account's gone. That's not the prop firm's fault. That's poor position sizing, planning, all of that. Your account's gone on this small of a move down. So they have strict rules. They tell you these things you have to do. They basically tell you you should not YOLO, you should not be putting all of this in one trade. However, people do. I don't blame the prop firms for people's poor trading. You know, like people make that decision to get way too over leveraged, you know, but they view it as, okay, well, I only need to make $3,000. I'm going to buy 5 of these. I only need to catch a 12-point pop and I'm there, you know, that's all I need. Or maybe they go to NQ and they know there's, you know, I only got to make you know, 3 grand. Well, if I got 5 NQs, and so I'm getting, you know, $100 for every 3 cents or whatever that NQ or that QQQ moves, I only need a 30 cent move on QQQ. They don't think about the fact that a 15 cent move on QQQ against them and they lose the account. So I don't blame prop firms for the issues that those traders have. They become a very, very slippery slope, which is what I wanted to talk about. It's happened to a few of my friends. I have a friend of mine that is, no exaggeration, tens of thousands of dollars in debt due to prop firms because they build this. And you know, we as traders, we need to be all right with putting on risk and understanding the risk and understanding we can lose money. Well, in a prop firm, they kind of teach you to ignore that, you know. You buy the account for 50 bucks and then you blow it on the first trade, then you go buy another. And then you blow it on the first trade and you go buy another. And so people always try to say, oh, it's only $50. Well, it's only $50. And you know, the prop firms have put out the statistics. 98% of people fail the eval, you know, the test part, and 98% of the people who pass never actually receive money. And I should say, you know, and it's different on brokerages. I saw somebody said they do a straight to funded, you know, there's different things, but I pay the $50 to pass it or to take the test. When I pass the test, I now pay another $150, and I'm just discussing Top Step. It's one that I kind of know their numbers off of my head. Now I pay another $150 to get that second account,
To activate
like
it.
the one activated. So no matter what, you're 200 in the hole. So maybe you pass 5 of them, and you know you're making mistakes. You're still getting too big, and you're losing them. Well, now you've lost $1,000 and you never really had the opportunity to make money. So they can become this very slippery slope where, you know, maybe you aren't really thinking about it. And, you know, maybe you go through 10 of them and then you're like, oh, well, you know, no big deal, whatever, you know, I'm going to try 10 the next month. I'm going to try 10 the next month. And one thing leads to another, and you've spent thousands over the year, you
And it's
know,
just
I
an
mean,
illusion, right?
yeah. And people think they think it's the answer. And that's where the issue for me in prop firm lies. Or, you know, maybe you didn't do good at options. Maybe you just don't get a good read on the market. You're losing money there. So now you go to prop firms. Oh, well, you know, when I'm trading options, my $200 option goes to zero or whatever. You know, I'm on prop firms because I'm risking less money. Well, the reality is for most people that they end up losing the same amount, if not more, by going the prop firm route. What I will always recommend to people is paper trade until you have a reliable system for futures. Then you go to a real futures broker. And I'm going to talk about it a little bit, but you go to a real futures broker and you trade micros, you know, you put $200 into a Trade Evade account and trade a micro or two. You can be wrong 15, 20, 30 points, not blow the account, and your money is not tied up behind anything. Say you have a really good day trading futures, you can withdraw that day. You also get additional tax benefits. Not a tax person, not going to get into that, but I can tell you right now from personal experience, when I was on prop firms and I filed the 1099s versus filing straight from my Trade Evade account, I save big money on taxes. I mean, percentage wise, I'm saving big money on taxes versus a 1099. You know, you are going to save money by trading on a real account. On a prop firm, you pass the test, okay? It takes you 2 days, you got to make 3 grand, you'll never see that money. Now, so you spent 50 bucks, then you spend another $150. Well, now more rules come into play for most prop firms. You can't just be a blowout trader. You can't just trade one day, make 30 grand and take a withdrawal. Very oftentimes, you can't have over 50% of your profit made in one day, and you have to have multiple days above a certain amount in a row. So on Top Step, you pass your account, you get your funded account, then you have to make $200 for 5 days straight. You have to make $200. It doesn't have to be straight, but you have to have 5 profitable days over $200. Then you can finally request 50% of your money. So you put in a lot of work and your money is still stuck behind these things. So what I always recommend to people, if you are on a prop firm and you're doing well and you're getting payouts, your goal should be to get off of that prop firm. Because the other part of it is, taxes aren't going to be good. Your money is tied up behind rules, and I don't know if there's any prop firms out there that don't have it, but you do a profit split. Oftentimes it's going to be like you get 90%, they get 10%, but you have to think of it, you trade for 2 days to pass the account. You pay him $200, then then you have to trade and you've already made $3,000. Then say you trade for 5 more days, you make your $200 a day, you're up $1,000. Well, you're technically up $800 due to what you put into it. Now you can take out 50% of your money. So you can take out your $500 or whatever, and then they're going to take $50 from you. So and they have to get paid. I don't hold this against them. I get it. Like, I understand it. If you're going to let somebody do this and you're going to have money behind them, and obviously in the beginning you aren't until you actually prove yourself. But as a business, you deserve that 10%. But we as traders shouldn't be willing to do that. So if you are on a prop firm and you are getting payouts, I highly, highly recommend you go to a real futures broker. Tradovate, NinjaTrader, all the ones that prop firms offers are real brokerages, and trade through them. You'll get better fills. There's some little things and other reasons to do it, but more than anything else, more of your money is your money. And that should always be the goal. So, I guess to wrap this all up, do I recommend futures? Absolutely not. If you like them and it's something you do try trading, then fine. But I am in no way, shape, or form telling people to quit trading options, quit trading shares, go trade futures. Trade them if you like them. They're simple. They're virtually shares. You do need a little bit more money to do it. And then second part, prop firms, do I recommend them? No. If you're going to do it, get a reputable one. Tradeify is a big one. Top Step's a big one. I recommend Top Step. I never had issues. I don't recommend them. I can't say that. But when I use them, I never had issues with them. And then the only time that a prop firm makes sense is when you don't have a lot of money. However, that's a very double-edged sword, because if you can't afford to fund an options account, you only need $200, $300, $400 to fund an options account, then don't make a prop firm be like this last-ditch effort. Don't, like if you don't have very much money, it doesn't make any more sense to put it into an options account than it makes it to put into a prop firm account. I understand that not a lot of people have money to start trading, and it can, futures or anything like that, it can be expensive. But if you are, low on funds, but the money won't hurt you if it's lost, then a prop firm can be an acceptable thing to try. However, if you don't have a well thought out strategy, if you don't have anything like that, if you don't have anything like that, then okay. But, I just really want to emphasize, I'm not recommending them. I just wanted to do some education on what they are, Well, Viral, US futures ran faster like CRCL. They run 1,000 times faster. I mean, I don't know. How you
Since you're mentioning the futures, River, do you think it's okay for people that are barely getting started and pretty
No,
much get the
a
feel of
big
it, of learning, like just like getting the experience but not actually staying with the prop firm? And then, if like you said, if you prove yourself, you're a good trader, get that money out and put it on a futures account. But I was also thinking, like, people don't do that because they over leverage and they'll get blown out and it'll be real money.
everybody over leverages, and that's why beginners have no business with them. You know, especially on a prop firm, you can be like, okay, I'm going to buy one. Oh, I'll add another. Oh, I'll add another. Oh, I'll add another. My account's gone, you know? And don't get me wrong, futures are great. And if you have good money and it's something that you're interested in, you want to talk a little bit more in detail about it, feel free to reach out to me. You know, just to use this example, and don't get me wrong, I know that it was a big sell on the Qs. You know, this downtrend right here that happened in a day is on one contract a $10,000 trade. You know, obviously you aren't going to top tick or anything like that, but you know, you take the retest up here and you stick short on this thing without any breaks of highs. I mean, maybe that wick got you, but this is a $10,000 trade on one contract, you know? So there's times and there's places for them. And if your account can support it, great. If your account can't support it, don't mess around, you know? Go find those cheaper names. Go trade your, you know, go trade your Citibanks, your Bank of Americas, your Apples, you know, slower movers, still relatively easy to catch a really nice percent on them every single day. Going to be a lot safer, going to be much better for people's mentality. However, if you have, you know, if you have a larger account, you're familiar with Trade and Spy, QQQ, those kinds of things, and you want to get into futures trading, then feel free to reach out, and I would love to, you know, I'd love to talk to you about it more in detail. But I just wanted to get a little bit of education out there as we hear more and more people talking prop firm. You know, it always comes in waves. This happened a couple of years ago too, and then they all washed out, you know. And if you're into it, let me know. If you aren't, great. But so with that, that's all I got. Anybody got any questions? I'm sure Norvin's going to yap something, but anybody besides Norvin got questions? And if not, we can call it a day here.
Since you were talking about $10,000 move right there, same goes to the upside as a QQQ contract. That if we get a nice uptrend,
Yeah. I mean, yeah.
$150 premium in the money could go to 800.
Yeah, and they can pay great, you know. I mean, that's like options are there is not technically speaking, there is no better risk reward than an option in the market because it has capped downside risk. Your contract can only go to zero, and technically speaking, it has unlimited upside. The issue with something like NQ or ES is they describe it, you know, when it's discussed, it is described as unlimited loss. That's not necessarily true because it can go to zero. I mean, it can't necessarily go to zero, you know, because like NQ could never go to zero, but technically speaking, on one NQ mini contract, the maximum risk is $435,000. However, to have that type of risk, NQ needs to go to zero, you know. So, but it also has unlimited upside, but the risk is massive too because it won't stop. You know, I won't say an advantage to an option, but a thing with an option is it can't go below zero. You know, like if you put $200 in, you can only lose $200. If you put, you know, you long NQ at the wrong time and you keep waiting for something to happen and waiting for something to happen, by the time the thing bounces, you can be down, you know, thousands of dollars, you know. So a lot of risk there. But with people trading pot firms, we have to talk about it just to let people know that risk is there. Don't be a DJ. Go in there and trade, you know, micros, and you'll be shocked at how fun the scalping and all of that stuff is. Very defined risk makes it really fun. And so it can be good to trade them. And if you're really struggling with options, or maybe you don't understand Greeks, or, you know, you shouldn't even say don't understand, but you aren't interested in Greeks, you aren't interested in studying how options work, but you have a slightly larger port, futures can be a nice thing for you.
Yo, River, before you leave, can you check Reddit if you have a chance? Thank you.
No Reddit tonight. Let's see.
Just one, bro. Come
Should I
on.
put weight on inside candles? Absolutely. Because inside candles lead to outside candles, and outside candles pay you. Yeah, but I love it. You know, you show me a whole bunch of inside candles forming me a nice little range. I'm oftentimes going to zoom to a longer time frame, you know, but you start looking at all of these things, you start looking at your 30-minute, and you start to say, okay, here are, well, I guess we got the gap up, you know, but here's all of my inside candles. I feel very comfortable buying at these lows. I also feel comfortable shorting at these highs. However, if I do buy at these lows, I now know what top I'm looking for. And if the breakout comes, which we know statistically 80% of the time it doesn't, I have the best possible entry because I bought the lows of the inside candles. It can work the exact same way. Maybe it breaks down, and maybe you're short at the highs, but I love using inside candles. I mean, it is one of the more classic price action things that there is. I talk about them all the time. Al Brooks talks about them all the time. Inside candles lead to outside candles. And the outside candles are where you start making some good money, you know?
River, I have a quick question, River.
Yeah, what's up?
River, so if you're experienced with options, and if you're consistent with options, don't you think futures, like you can be good with futures as well if you know price action?
Oh yeah, and that's the thing. It doesn't matter what you're trading or how you trade it. You trade everything the same. I don't care if you're trading gold futures. I don't care if you're trading same day SPY contracts. Everything is treated the same. All of your strategy should
Yeah.
always be the same. You just need to start defining your risks and rewards differently.
For sure.
And like we discussed on futures, it's stupidly easy to know your risk and reward because break even is always break even. We've all known, we all know that we've entered an option and maybe it goes a little bit against us and then it bounces, we buy SPY calls at 600. Please don't ever just buy. That's so dumb. But we buy SPY calls at 600 and it goes down to, 599.80 and then it goes back to 600 and we're down $1. That's where even though it's the exact same spot we entered at, that's where options get trickier. And if you don't understand Greeks and and I can't even say don't understand, just haven't studied them. That's always going to make you mad. And it's always going to be something you're fighting. For me, that's why I love options. I love the wheeling and dealing you can do on them, and the little as you get more comfortable with them and understand how they work and you can risk those buying calls on a volatile knife outside of the B bands when the calls IV is absolutely crushed and make way more than you should on a little bounce, that's why I like options.
For
but
sure.
Oh shit,
I'm also
River's
kind
going
of a
full
nerd.
port AT&T. Let's do it.
I love AT&T. But I'm
River-
also kind of a nerd and I like that side of options and I like the craziness of them. So that's why I trade them. Like I
sure.
said, futures are, you don't your entry is your entry, and
Yeah.
what I always teach is when you enter, anything that happens between taking profit and stopping out is noise, and that same thing applies to futures. Options just have that little bit of fun where if you time your entry better, you make more money. Entry is everything. I don't care if it's futures, shares, shares a little bit less, long-term shares, of course, but if you're trading shares for a trade, entry is everything. A good entry can turn a good trade great, and it can keep a bad trade not too bad. Entry is everything, no matter what you're trading. Yeah, viral. Actually, next lecture, and there's some of my most popular ones. And I'm not going to say we're necessarily going to talk about that strategy, but we're going to talk price action. I've been getting requests for it, and so next lecture is price action lecture, and we'll be talking all kinds of things. The types of candles that I like to trade, and I'm talking real price action, not the blah 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 stuff that people talk today. Reading the candles and what are the candles telling you and tying that up with, I don't want to say patterns because I'm not talking bull flags, head and shoulders, none of that stuff. Just repeatable things on a chart. And so next one's price action. It's my favorite lecture to do. I mean, it's mostly what I trade price action, have for years. And so it's my favorite thing to talk about. So we will be on it. Yep.
Yo, River, you know what I actually did learn, bro? That you always have to have a stop or else you'll always blow your account.
Yes. Yeah. Yeah. And I teach you need to have two. Maybe I buy this and my planned stop is a close under this level. My, oh shit, I'm stopping out, I'm wrong, is somewhere down here. And that stop don't move. That is maximum pain. That is like end is near type of stop. And so you stop, What would I say my trading strategy is in a nutshell? Beats me. It depends on what the market's doing, you know, because you got to have a slightly different strategy for trending days or ranging days or things like that. But I will say that I will say that my favorite time to trade is like $1.50 range on SPY. You set me up on $1.50 range on SPY and I'm loving life. You know, if this was just like if this was going on during market hours, I'm in heaven because I feel comfortable buying and I feel comfortable shorting and I feel comfortable buying and I feel comfortable shorting or you know whatever it is. So I feel comfortable in ranges. Do you get 1,000%ers? No, but you know, maybe somebody buys some calls or whatever and they hold and they get their, you know, their 50-60% pop. Well, we made 25%, we made 25%, we made 25%, we made 25%. I would rather do this than just ride it, you know. So
You know what? It'll add up.
my favorite type of trading is range trading. I like trading in ranges. And then because I like trading in ranges, we oftentimes in VC, when the breakout finally comes, you know, everybody wants to catch this breakout. Everybody's buying these candles, looking for this breakout. I have no interest in being long here. I have a lot of interest being long here. So oftentimes when in my voice chat, when we really get those runners, I don't want to say we're bottom ticking, but because we're trading bottoms of ranges as opposed to trying to, you know, buy strong candles for the breakout, we're already in there. So anybody who's chasing the breakout or buying these highs when it comes, they're buying our trims, you know? So that's how I like to trade. Ranges lead to breakouts and buys at the bottom of ranges 100% of the time lead to the best possible entry for a breakout. So that's why I do it. And everybody wants the trend. And, you know, I'm a big statistics guy in the market. 65% intraday, time spent intraday, the market's ranging. So if you hate ranges, that means you hate trading 65% of the time. And if you're chasing those breakouts all the time, you're oftentimes getting smoked because oftentimes the real move is the range, you know? Always, of course, take note of any trends that are occurring in the big picture. So we know, you know, if big picture trend is up and we're ranging, we're obviously going to feel a little bit more comfortable buying the dips in the range than we might feel shorting the rips because overall market is bullish. Whereas something like this, where we have a nice little, you know, short-term downtrend happening, we can kind of say, okay, we're starting to range, but you know, we were weak. I feel okay shorting these. I know my worst case scenario is a stop over here, so I can feel okay shorting those. But it's always, what does the market tell you to do is the most important thing. Okay, well, with that, everybody, I'm going to go eat dinner. Thank you all for being here. And we'll catch you tomorrow, Friday. Let's have a little bit of fun.
Later, River Boy. Take
Later,
care,
Norman.
buddy.
Thanks for being here. We'll talk to you guys soon. Thanks, everybody.
Take care, brother. Have a good night.
Yeah, you too, man. Thank you.